Hello and welcome to this March edition of Amundi's Market Review. In February, risk asset prices continued to drift higher, while corporate credit spreads tightened. The US high yield segment in particular reflecting expectations of a more constructive economic outlook ahead. In order for equity markets to continue to perform, it is key that central banks remain accommodative and preserve easy financial conditions, which imply rates will have to stay low. This is the rationale behind the end of February interventions of the European Central Bank and the Bank of Japan in order to calm the rapid surge of US government bond yields. But let's look more in depth what happened in February. The expectations of a successful vaccine rollout and a sizable US fiscal support had been welcomed by market participants who started to price in a faster improvement in the US growth path. Therefore, investors revised their inflation expectation higher, and eventually the US long-term nominal yields moved higher as well. German interest rates mirrored this movement. A fascinating debate opened up on the size of the US fiscal package. We do not think that the US administration is overdoing this action. However, we do see inflation moving higher, hitting 3% in the second quarter before stabilizing. We believe that the slack in the labor market is huge, and this will allow the Federal Reserve to stay accommodative for the time being. On all these fronts, Europe is lagging behind. Despite a correction in the last week of February, equity markets posted positive gains, 3% on average, with value indexes recording outstanding performance, almost 6.5% both on EU value and global value. On currency markets, the euro remained almost stable, closing at 1.21 US dollar, while the UK sterling and the Japanese yen both appreciated against the dollar. Oil is the top performing asset class of the month, with a return of more than 20%. The movement is due to, firstly, rosy expectation on the global economic recovery. Secondly, some rotation by investors to different asset classes, in particular repositioning on cyclical commodities likely to benefit from the recovery. And finally, the recent extraordinary weather condition in Texas that led to the temporary freeze of 40% of oil production. This supply shock is temporary, and we do not expect it to result in a global over-demand imbalance going forward. OPEC maintains a lot of margin to increase extraction, as current production is significantly lower than pre-COVID levels. We therefore believe that oil prices should remain at their current levels or slightly lower in the medium term. Before concluding, let's briefly comment on Bitcoin. The price has tripled in just 3 months, closing end of February with a monthly performance above 33%. Speculation, diversification, and fear of inflation explain part of this dynamic. What is happening is indicative of broader developments that are relevant to the data design and the effectiveness of financial markets regulation that policymakers will have to take into consideration. While stimulation measures continue to foil the economy, investors should still prefer equities to bonds, keeping a tilt toward more cyclical markets, in particular Japan and Asian emerging countries. Eventually, equity markets will benefit from a bit of more inflation and central banks committed to stay accommodative. We don't think it is time to take a contrarian view on our rates position and recommend a short position on US duration. We stay risk-on in credit markets and increase the tilt towards green and social bonds. Against inflation risk, we started building hedges with break-even and more generally with an investment approach that tests each investment case against a possible rise in inflation. Thank you for listening. Please keep safe and see you next month for another market review.